Hey everyone, welcome to the 12 Respond Show. I'm Sarah Granelli. We're here with Nate Beauvais from Sowa Financial Group. Thank you so much for being here.
Hey, my pleasure. Thanks for having me.
We're going to cover a wide variety of things when it comes to finances, but first tell me a little bit about yourself.
Well, I'm from Lincoln, Rhode Island. Actually just moved there a couple years ago with my wife and my 3 kids, and I've been in finance business for about 12 years. I also a musician. I have a band on the side. It's called Funky Submarine. Check it out at funkysubmarine.com if you like music. But that's my main passion is finance and markets and music.
How did you transition from, I'm assuming that you were a musician right as a young kid, then getting into finance? I feel like sometimes you don't realize those things can go hand in hand.
So I was young and didn't have any responsibilities, and so playing the guitar was fine. But once I wanted to have a family, I had to find a career that was going to pay the bills. So I was always interested in economics and personal finance, so it was a good fit for me.
And good with numbers.
Yes.
What kind of instruments do you play?
I play the bass guitar and I play the piano. I also arrange all the music for the horn section in the band. I do everything for the band except play the parts.
Amazing. How does your background in finance, does it play a role in what you do as an artist?
One of the things I think it's opposite, actually. My background in music has helped me in finance.
Interesting.
So I taught music lessons for about 10 years, one-on-one. With adults and children, and it's a complicated thing, music. It's tough to get off the ground, it's difficult. And when I work today with clients, it's kind of the same thing. I'm explaining something that's difficult to understand, but people want to understand it. They're passionate about coming into here and figuring this out. And it's a teacher. You're trying to teach to the student. Every student learns a different way. So talking with clients, too, about their personal finances, everyone has different fears, different motivations. So trying to find out what makes them tick is essential to being an effective financial advisor. So those are the kind of the parallels I always saw between teaching music and actually advising clients about their finances.
Because finances can be overwhelming.
Sure.
Especially because it's so complicated.
Yeah.
And to feel overwhelmed that you don't really have a great grasp on finance, because I feel like it's not taught very well in schools, as much as it should, because it involves our everyday life.
It is changing, though. It's getting better.
Yes,
When I was a kid, it wasn't really taught at all. And now you'll find many school districts where it is an elective that juniors, seniors can take in their high school. And I think that's an awesome thing.
So for people getting out of college, you're in your 20s, maybe 30s, 40s, when you're getting older, what of the financial mistakes that they might be making that you see?
I think a lot of times at that age, it's prioritizing certain things over others. I meet too many young people with massive car payments, a brand new car. You're probably better off buying a used car and having a smaller monthly payment on the car and directing the other money that you would have had to go to the car somewhere else, to paying down a school loan or something like that. So prioritization of goals is probably the biggest mistake I see in 20s and 30s, 40s, that kind of thing.
How do you figure out where to put your dollars when you're in that age bracket? I mean, you want that nice car.
Yeah.
You want to go out with your friends.
Sure.
You want to go on a date, which can be expensive nowadays.
Sure. Every time I go to the restaurant, it's like $100.
Exactly. So how do you figure out your priorities?
Everybody's a little different, What I would say is if you have a job and you have a 401k and the employer is offering to match your 401 contributions, you have to go take care of that. You got to go get the match from your employer, because that's part of your compensation. Imagine that you went to a job interview and they said, okay, we're going to offer you $85,000. And you said, no, you know what? I'll take 80. That's essentially what you're doing when you're giving up the match on your 401k. So if you have at least a match, let's say it's 3%, you got to go put 3% in your 401k. No questions about it. Beyond that, if you've got debt that you're trying to pay off, well, what are the interest rates on the debt? If you've got high interest rate debt, like credit card debt, that's going to be charging you, say, 18, 20% annually, on your credit card, you got to pay that stuff off quickly. On the other hand, if you've got a mortgage and you were lucky enough to get it, 5-6 years ago, pre-COVID, and you were paying, you got 3-4%, hey man, that's a great mortgage rate. Don't pay that off right away. Pay it as agreed upon, and take whatever extra money you have to pay off maybe other high interest rate debt, or maybe invest it in your 401k or an IRA.
How do you balance looking your debt to income ratio? What should their goal be?
Ratios are a great way to look at your finances because it can apply in so many different situations, right? Let's come back to the housing one with ratios. I think it's a good one. And I say all in, whether it's your mortgage or your rent, if it's going to exceed a third of your take-home pay, you're going to have a hard time because of all the other expenses that come up in life. And nowadays it's really tough. Rents have gone way up, the mortgage rates, whether it's the home prices and the interest rates. But if you can keep your housing payments between 25% to like 33%, that's a good place to be. As soon as you get up to that 40% range, you start to feel it, in your monthly budget.
So ideally, someone's at 30%, and they have an idea where they want to put their dollars. Where do you advise them to put their money?
Again, this is going to be really dependent on their certain circumstance and situation. The younger you are, the more sense it makes to put money in a retirement account because you're going to have a long time horizon, which is a fancy way in my business of saying how long till you need the money. So if you're 30 years old and you've got a 401k, then that's where all the extra money really should be going. But that's not to say you shouldn't be thinking about other things too. Of course, if you've got a car that is going to fail on you pretty soon, you got to get a new car. Yeah, you got to start saving money for that too. So there are a lot of competing goals that are going to be in your life, but every single person is going to be different, so it can be tough sometimes.
When you're thinking about your future goals and you're investing into your retirement account, do you recommend like a Roth IRA or an IRA? Describe what those are.
These are great questions. Yeah. So the two differences between a Roth IRA and a traditional IRA. A traditional IRA, the money goes in pre-tax, which means it doesn't get taxed on the way in. And when you take the money out later on in retirement, it will be taxable to you, 100% of the money. A Roth IRA, the money gets taxed first, and then it goes into the account. And then later on in retirement, when you take the money out, you pay no tax at all on the money, which is a great way to go. So the younger you are, I think the more it makes sense to do Roth contributions. And even if you're in your later years, let's say you're 50 years old, if you're in a medium to low tax bracket, so let's say 22, 24% tax bracket, then I think Roth is still a good idea. When you start getting up into those higher tax brackets, like 32%, now a pre-tax contribution can make sense because it'll lower your taxable income today. But if your income is under $200,000, I think Roth makes a lot of sense.
How much do you advise people to put in? I mean, if you're already contributing your max, you're thinking of maybe you want to buy a house, or maybe you don't want to buy a house, but you still might want to go on a vacation. How do you manage?
So for younger folks, it comes down to that match again. If you're getting a 3, 4, 5% match, that's what you have to do up to that point. But then if you're trying to buy a house with a spouse, for example, that's a very good goal to have, and I would encourage everyone to save for a house. So maybe in the beginning when you're younger, in your 20s and 30s, you just put the match in the 401k. That's enough. You got your whole life ahead of you. And then on the side, you can save some money for a house as well. But again, I keep coming back to that match. That's part of your compensation. If you give that up, it's like giving up income. So you really have to go get that.
When you're looking at retirement, you think, oh, it is so far away. Even if you're 50 and you're like, it's still
15, 20 years away.
I'm never retiring. I love to work.
Yeah.
What is the ideal number that someone has stored away in their retirement account? Do you work backwards from that number to think, hey, I'm 20 years old, I should invest this amount to by that time when I retire, I'll have X amount of dollars?
For younger people in their 20s and 30s, I try not to get them to think about that specifically, about spending money in retirement, because it is so far away. It's hard to know what you will even want to do with your life at that point. It's a lot easier to talk to someone who's, say, 62 and on the doorstep of retirement to talk about what their life's going to look like in retirement. So when it comes to trying to figure out like that magic number, first of all, it's going to be different for every single person. I've met single people who are in their 60s who spend $3,000-$4,000 a month. I've met single people in their 60s and 70s who spend $10,000 a month. Everybody's different. So it's a hard thing to do as an advisor to tell you, hey, you need X number of dollars in your retirement account. But I'll come back to what I said originally, the priorities, when you're younger. And that applies later on in life too. If retirement is really important to you and you really, I can't stand working, then yeah, you should put a lot of money in your 401k. But if you're in a situation where, hey, I love what I do and I could see myself working well into my 60s and then even into my 70s, then maybe it's not that big of a deal for you. Whatever the case is, you really should work with an advisor. And now maybe I'm biased because I'm an advisor, right? But it really is so personal. Every person to person, every situation can be different, that you really need to work with an advisor to figure out what that number is for you.
So there is no ideal buffer, some cushion that you can, like, is it a target goal?
Yeah, so let's talk about emergency funds.
Yeah.
Okay, so that's where I can say, all right, figure out what 3 to 6 months of your expenses are, and that's your goal for for emergency fund. But when it comes to a retirement fund, it just doesn't work like that. It's really tailored. Every person can be different, and it's hard to give advice on what the nest egg number should be.
All right. So when we come back, we're going to talk about CDs, stocks, and other investments. We'll be right back. All right, welcome back. So if you're looking at your portfolio and you're thinking of stocks, bonds, mutual funds, CDs, how do you know where to put your money?
Well, I'll come back to this word I used in the last segment, which was time horizon, right? It's how long do you need to use the money? I'll give you a perfect example. I had someone come into my office the other day. They sold a rental property, and they were going to reinvest it and buy another property within the next year. And it was a good chunk of change, it's a couple $100,000. And they said, hey, I want to give this money to you to invest. And I said, okay, well, you're going to buy another property in a year, right? And they said, yeah. And I said, well, honestly, I think this money belongs in the bank, in a CD, because you're going to need it in 1 year. If I put it in the stock market, I mean, Lord knows what can happen in the stock market over the course of 12 months, right? We just go look back 12 months from today. You can see it. It can drop very quickly and without notice. So when it comes to deciding, should I invest in stocks, bonds, a CD, or whatever, it really comes down to that question, when do you need to use the money? So if your time horizon is long, and it's 20, 30 years, like retirement, then yeah, stocks are a great choice for that. Mutual funds can hold many different types of investments. So you can have a mutual fund that has stocks. You can have a mutual fund that owns bonds. You could have a mutual fund that owns commodities, like beef or cattle, stuff like that, those kind of things.
And the metaverse.
Lunar real estate, I think is coming next.
Yeah,
right.
That's fascinating. When people are looking at CDs and rates, and I know they usually turn to you to do this for them, but how can people shop around to figure out the best rate?
I think right now I advise people when they go to their banks just to look for the one that has the highest rate. If it's a CD, then it means FDIC insured, so you're getting that protection. And sometimes the highest rate is not the longest maturity, right? So a CD may mature in, say, 6 months, and it's paying 3.5%. Yet a 2-year CD is paying 3%. Well, what's up with that?
Right.
Why am I getting a lower rate for? But I have to commit the money longer. Well, that's actually unusual. It's not unprecedented, but we are in an unusual time period when it comes to interest rates. It's called an inverted yield curve, which means the shorter maturities are paying a higher rate than the longer ones. It's kind of awkward for consumers in the way I just described it.
Yeah.
It does happen from time to time in the economy, and we've had one for the last couple of years, but it is normalizing as we speak.
And when you're looking at CDs versus high yield savings accounts, if the interest rates are around the same, should you just put your money in a high-yield savings account? Will you describe what a high-yield savings account is?
Sure, they can be very different. I've seen many different flavors of them. The number one thing is look for is it FDIC insured? Are you going to get that insurance from the federal government if the bank goes under? And there are limits to that, usually about $250,000 per person. So if you have more than $250,000 in a CD at a bank, only the first $250,000 is covered for what I'm talking about. But a lot of high yield savings are not FDIC insured, and they pay a much higher rate too. I've seen 6%, 5% on high yield savings accounts. Whereas CD, depending on where you go, the big national banks are paying almost nothing compared to the smaller credit unions. So in my experience, credit unions, local banks will have better CD rates than big national chain banks.
So it's safer to put your money in a CD versus a high yield savings account if it's not?
Yeah, I would think of it as like a ladder that you climb, right? And the first rung of the ladder is a CD, and then the next rung on the ladder would be like a high yield savings account. Yeah.
Looking at the interest rates now, I mean, the target has been at 2%. We've been wanting interest to go down to 2%
Sure.
With the Fed lowering rates. How is that impacting people and where they're wanting to put their money?
Well, when interest rates go up and down, this is controlled by the Federal Reserve. And the important thing to remember is that the Federal Reserve controls short-term interest rates. They do not control long-term interest rates like the 30-year mortgage. So they can sort of influence it, but those rates are really by a majority influenced by market participants in the economy here and globally, frankly. But when interest rates go up, typically bond prices go down, and vice versa. When interest rates go down, bond prices go up. So if you think about it, interest rates really peaked in 1980. I mean, a 30-year mortgage was 16% in 1980.
Yeah.
It's been coming down for a long, long time, and then COVID was really the bottom, where we really finally hit absolute zero.
Yeah.
And then things have been coming up from there. But in 2022, the rates went up really quickly. It went from like 0 to 5% in about a year. That had never happened in the history of the human race. And I'm not using hyperbole. To go up that quickly like that in the span of a year. And so bond prices really got torched during that time period. I saw many conservative investors who were invested in bonds dumbfounded by their portfolios to see that that's what had happened. So there's been a reluctance to get into bonds because of that, sort of like post-traumatic stress syndrome, disorder, whatever they call that. That's like I experienced that terrible thing with the bonds. I don't want bonds anymore. Well, that's usually a great time to buy an investment when everyone hates it. So bonds have been, I think, a much better investment lately, but that's more appropriate for conservative investors. If you're approaching retirement. If you're young, you're 30, you're 40 years old, in your 401k, I don't know if you need bonds, to be honest with you, in those situations.
Will you describe what a bond is in case someone watching this or listening doesn't know what a bond is?
Yeah, so it's a debt. It's a loan, right? And so think about your mortgage, right? You in a mortgage, you are the borrower, and you're borrowing from the bank, right? When you buy a bond, the role is reversed. You're the one lending the money, and you're getting paid interest from it. You could buy a government bond from the U.S. Treasury, where you give the government $10,000 and they promise to give you 3% every year. And then after 10 years, they'll give you your principal back. You could buy a bond from Coca-Cola. Same thing. Give them $10,000. They promise to pay you 5% interest for the next 10 years, and you'll get your principal back at the end of 10 years. But the problem with bonds right now that many people are afraid of is that inflation is causing the prices around us to go up. Yet when you buy a bond, your interest rate is fixed. It doesn't go up with inflation. So it feels like those payments are smaller as the cost of living goes up around you. That's one of the challenges with bonds right now. If
people are looking to invest in bonds, like I feel like you're kind of alluding to, that maybe this is a good opportunity for people to get into the market, what bonds should they be buying? I
always stay diversified. I don't like to say, buy this company's bonds or that country's. You have to stay diversified. And I think, you mentioned mutual funds a minute ago, I think are the best vehicle to own a bond fund. But again, these are really personal decisions that you have to make based on your own circumstances. And so when it comes to which ones you should buy, you should always sit down and talk to a professional.
How do you think, I'm going to pivot hard here, ChatGPT is influencing where people are putting their money? Are you finding that people are coming into your office and saying, hey, I looked this up on Chat and it says I should put my money here?
Well, I don't think ChatGPT actually gives financial advice per se, like specifically, like I'm doing. It's almost like if you were going to Google it. It's just a newer version of that. What I hear more from people is, how do I invest in this stuff, this AI stuff, and make some money, which is hard to do. And the valuations have gotten so sky high now that it's hard to know when the right time to get in and on that stuff is. No, I haven't heard that from people like saying that they're getting their financial advice from AI yet. It could be coming for sure.
Well, I will say that I don't know, a few months ago, I was really interested in like how chat really worked. So I was like, okay, if I invest X amount of dollars each month in 30 years, how much will I make in the market? And it gave me kind of a good financial breakdown of how much I should be putting away. And I think I put in like $1 million by the time I retire. Right. It gave me that kind of financial breakdown.
That sounds like a financial calculator.
Yeah.
Like it says, okay, well, if I have this rate of interest or this rate of return, how much do I need, yada, yada, yada. But if you were to ask ChatGPT, well, how do I get that rate of return? You'd probably get some different answers.
And unsafe, maybe.
I mean, if you're targeting 3%, it may say, a bank is a good place to go. But if you're targeting 12, 13, 14%, then, that's a lot harder to do.
If people are looking for compounding interest, where should they go?
Compounding interest can work anywhere that you have money invested. It can work in your checking account. It can work in your savings account. It can work in a CD. It can work in stocks and bonds. Any kind of investment vehicle will pay compounding interest.
Once you invest, if you're doing it on your own, should you reinvest your compounding interest?
Depends on what you need. If you need income, I have many clients who take the interest off of the accounts, the investments, and so that's not compounding, right? They're not reinvesting the interest. They're taking it and spending it. Many people are supplementing that with their Social Security in retirement, for example.
If you could give financial advice to anyone, what is your top tip?
I'll come back to priorities, how we started this conversation.
Yeah.
Make sure you have your priorities straight. One of the things that is interesting, I came up with someone, they got a big chunk of money from selling a house. I think it was like $100,000. And they said, what should I do with the money? And I said, well, are you contributing to your 401k at work? And they said, no, I'm not. And I said, well, believe it or not, contributing, let's say $1,000 a month to your 401k for 20, 30 years while it's invested in stocks is way more powerful than getting $100,000 today. And that's hard to wrap your head around, right?
Right.
It feels good to get a big lump sum of money.
Yeah, imagine what that looks like in your bank account.
Yeah, right. But big, real, true wealth is built slowly over time. It doesn't happen usually in one lump sum setting like that. So that's one of the things that's hard to people to wrap their heads around. It's like it really is all about keeping at it month after month after month, or paycheck after paycheck going into your account.
If someone isn't ready for a financial advisor yet, but they want to make sure that they are financially stable in their future, are there any websites or books or avenues, even podcasts, that you think people should listen to that will help them understand their own finances?
Well, I'm a little biased
Yeah.
because I host a radio show.
Yes, that's true.
But you can check out Don Sowa's Money Talk wherever you get your podcast and listen to us talk about our advice on that. There are some great books out there. I would recommend The Psychology of Money by Morgan Housel is a great book. Just Keep Buying by Nick Majuli is another great book that I recommend to a lot of people, all ages. And they're great books because it's not heavy in mathematics or jargon or stuff, investment jargon, stuff like that. It's real life stories that they tell that I think a lot of people identify with stories.
Speaking of stories, is there any financial horror stories that you've heard that could help other people avoid?
Horror stories. Well, lately, one of the big horror stories that I've seen has been adjustable rate debt.
Yeah.
So like think of like a home equity line of credit. People took out a home equity line of credit in 2001, 21, 22, before interest rates went up, and they had a low rate of interest. And then when interest rates went up quickly in 22 and 23, all of a sudden now they're paying double, triple the interest on their loans, and they didn't know that even existed. So when you take out a loan, you really want to know, is of interest, or is this a floating rate of interest that can go up and down with the whims of the market?
That must be, I can't imagine that how much extra you are paying each month. That must have a huge impact.
It's very, very difficult in some situations, yes.
How do you have that conversation with someone if they're now struggling financially because of that kind of situation?
It's that P word again, priorities, right? We take a look at their budget. What are you spending your money on? How much do you want to get rid of this debt? And if it's really that important to you, then we have to look at other areas. This is why it's important to keep a budget, and look at where all your spending is going so you can make adjustments.
Your extra Netflix account, your Hulu account.
Stuff like that, yeah.
You might be able to chip away.
Right. Yeah, you got it, yeah.
All right, great. When we come back, we're going to dive a little bit more deeper into the best financial practices. We'll be right back. Welcome back. Inflation is really impacting everyone.
Sure.
In some ways that they might not even notice. How is it hurting consumers?
Well, the big things that we need in our lives are shelter, right? Groceries, healthcare,
Yes.
education. These are the things that have been really going up in price more than other things. You think about like a flat screen TV today, it costs less than it did, maybe 10 years ago. Cell phones, smartphones.
Yeah, tech is getting cheaper.
Yes, right. Technology gets cheaper, but the essentials seem to keep going up. And I think that inflation is one of the biggest problems for pre-retirees. So if you're working, if you're younger, there isn't going to be inflation unless incomes rise, because that's what drives inflation, people having the money to spend. But if you're living on a fixed income in retirement, you've got Social Security, maybe a pension, you don't have an income. So that's really problematic for you. So you really want to structure your investments in a way that can keep up with inflation. And that means having a healthy dose to stocks. And that can be, and what is healthy could be different person to person. But also having commodities in your portfolio. So for example, did you know that cattle futures, beef, has outperformed the S&P 500 over the last 5 years?
What?
Yeah. Yeah, you made more money in cattle futures over the last 5 years than you did the S&P 500.
Wow.
So that's what I'm talking about, is those kind of things. So if inflation is bad, it's like an insurance policy in your portfolio, having exposure to commodities in the economy. Could be sugar, could be wheat, could be lumber. Could be petrochemicals, gas, oil.
Is this why the price of gold?
So gold has been on an absolute tear. Yeah,
Everyone is trying to go to what is it, BJ's? I think it's
Costco.
Costco.
Has the selling the gold bars.
Yeah. Trying to
So
find gold bars.
gold can definitely be a part of that. How much should be gold is debatable between advisors. I don't want to get into specifics of that too much, but definitely having a broad basket exposure to commodities, I think, is really important right now for a well-diversified portfolio. But then again, not everyone needs a really well-diversified portfolio. There are different levels to this. There's a lot of nuance to it.
When people are looking at interest and how it's really impacting them, it really hits your credit card.
Yeah. So credit card rates went up a lot too. And so people find themselves with maybe multiple credit cards and how to pay that off. Sometimes consolidating those credit cards can be useful, but it depends on the terms and conditions of what you're doing in the consolidation. So it's hard to speak to that directly. What I would say is that if you have multiple credit cards, find out which one has the highest interest rate and pay that off first. That's how you always want to tackle debt. Find out which one has the highest rate of interest, pay that off first, make the minimum payment on everything else. And then when that highest rate card is paid off, then just take that money that you were putting towards the other cards that you have.
So it's a snowball versus the avalanche approach.
Yeah. That's the way I think about it. I like to do it. But there could be other ways. There's as they say, more than one ways to skin a cat.
That works. Would you recommend people rolling over their debt onto a 0% interest credit card, or is that just kind of prolonging the problem?
Well, 0% sounds great. How long are you getting 0%? And then what are the ramifications once that period is up? The devil is in the details in the debt consolidation. So it's hard to speak to any of those. You really have to read the fine print. And know what you're getting involved in, because some of those deals can be really good. And I've seen other ones that are a little misleading at best.
Yeah, because I can imagine if you roll over a big chunk of debt, you don't pay it off in the year or whatever the time frame is, then you're hit with all the interest.
Yeah, it can really snowball and get out of control on you. It's the one thing that really derails the most people that I meet is unnecessary debt, and not taking the high interest stuff seriously, because it's compound interest working against you. That's kind of what it is.
How many credit cards do you recommend somebody should have? Is there
Well, I'll tell you, I'm a financial advisor. I'm a financial expert.
Yes.
I have one credit card.
Okay.
That's it. And I pay it off in full every month. And I get all the points and all the bells and whistles that you get for that. Get some airlines tickets paid for once in a while.
The points are great.
But the deal is I only use it if I can pay it off in full every month. Now, that might not be possible if you've built up a big balance. I get that. You got to start paying it off little by little. But if you're going to continue to use the credit card after you get the debt down, don't use the credit card unless you can pay it off in full every month.
What if you have a credit card that you're realizing the interest rate is incredibly high and you'd rather get a 0% interest rate credit card or something with a lower rate? Do you recommend closing your credit card or leaving it open?
Well, there are some funky rules when it comes to your credit score. It's called a credit utilization ratio, and which that means is if you've got more credit available to you to use, sometimes that looks bad to the credit companies. So they lower your credit score. So it can be difficult. I like having as little credit cards as possible, getting it down to one. So if you can consolidate the debt on good terms, I'll stress that, good terms, it is a good idea. But again, those terms can be different, a contract and agreement to agreement.
How important is it building healthy credit, and how does credit card debt impact your credit?
Oh, it's going to impact it a lot, but how important is a great, interesting question that I like to talk about with people, because when you're younger, it is very important, right? It's not like you're going to buy a car cash, so you're going to have to take out a car loan, and your house, the same thing. You're going to have to take out a mortgage someday. But when you get to be older, if you're in retirement, your house is paid for, you don't have any debt, no car loans, you're living off your Social Security and you've saved up a lot of money in your 401k, you're never going to borrow money ever again, hopefully. So you shouldn't care what your credit is. I tell many of my retired clients, don't even care. Don't look. Doesn't matter.
Doesn't even matter.
You're not taking out a loan.
Yeah.
That's the only time it matters is when you need to borrow money. And when you get to a certain point in life in retirement, there's no more borrowing money. No more borrowing money.
Yeah, hopefully your wealth is built up and you're good to retire at a smooth path forward.
Yeah, exactly.
All right. Well, thank you so much for being here. Really
My pleasure.
Appreciate it. And of course, you can catch the show on our 12 Plus app.